All right, I'm back here with the official launch of my algorithmic trading project. This is the first major project that I'm introducing on this channel. If you don't know what algorithmic trading is, it is basically computers trading assets based on algorithms. So a set of rules that you create, you tell a machine to make trades for you, and it makes trades based on that set of rules that you give it. That is contrasted with discretionary trading. I've been a discretionary trader for quite a while, several years now, meaning that I'm just looking at the charts and I have strategies and I'm really just manually making decisions about when to enter and exit trades. And there's a bit of, human discretion involved. Also human error. And that's the first thing I want to talk about. This video is going to be kind of an overview of what this project is and, what my plans are. So let's talk about the difference. Why would I want to have a computer trading for me? Computers, for one, they do not make mistakes. Okay, so if you have been trading for a while, I'm sure at some point or another you have accidentally typed in an order wrong, put an extra zero on the end of something, bought a put instead of a call. I've done it before, because I'm tired, not paying attention, a lot of things going on, lots of stuff on my mind, whatever. It happens. We're human. Computers are not human. They don't make mistakes like humans do. They do exactly what you tell them to do, nothing more and nothing less. That can be a good thing if you have a very well thought out algorithm or set of rules that you've given to your machine. That can be a bad thing if you have not thought things through completely or not done sufficient testing. It can, especially with high frequency trading, it can kind of accelerate the loss of money. So that's important. But, one of the benefits is that they do not make mistakes. They will do what you tell them to do, and that's all they will do. What else can they do? They can do math very quickly. When I'm sitting at my desk, even though I have calculators that I've made and I have strategies and I've done a lot to make sure that I don't have to think too much when I'm actively trading, still, there is some thought involved. There is some math involved. Computers can do that thinking and those calculations a lot quicker than, even the best of the best out there. There's just no comparison. There's no human that can do things as quickly as a machine can when it comes to, making decisions based on rules and doing math. Another thing that they can do is they can execute orders or submit trades a lot quicker than a human can. That is important because it allows them to trade at a much higher frequency than humans can. They can take advantage of very brief inefficiencies in the market that humans, we might notice, but maybe we're not quick enough to be able to take advantage of that, to think it through, type in an order, execute the order. Sometimes things just happen quicker than a human can account for and take advantage of. Machines, they can do that a lot quicker than we can. So, these are just some of the major benefits of having a computer trade for you. I don't plan on replacing my, my discretionary trading with algorithmic trading, but it is definitely something that I want to explore and eventually, hopefully, can have a purpose-built machine that can do some trading for me with some amount of money, capital that I've allocated to it. That's the ultimate goal. But there's a lot of steps along the way, a lot of things that I need to accomplish before I get to that point. I don't just want to create some algorithm and start trading. You need to experiment. You need to don't just give all your money to a machine and expect to make a profit. So with this project, there are a few different phases. The first phase is creating algorithms, doing research on existing algorithms, and creating my own algorithms and testing, taking a scientific approach and actually putting them to the test against historic data. You could call that back testing. So let me just make myself some more space here. That's going to be phase one, backtesting strategies against historical market data. I plan on taking a scientific approach. I'll get into that more as the project progresses and I get more into the details, but that's essentially the first phase is backtesting. And then once I find something that's promising, I'll move on to forward testing. Forward testing would be first, not using any real money, just kind of taking my algorithm that I've developed through backtesting and refining and applying it to real-time market data. Not trading with real money, but just taking the data as it comes in, as it happens in the real world in real time, applying the algorithm to it, and then having it basically simulate trades. You could call it paper trading, I guess, against real-time market data. That would be forward testing. And then after that, if it still looks promising, then I would gradually start to move into giving it real money. I would allocate small amounts of money to some account that a machine would have access to and be able to trade for me. And then as time goes on and I begin to trust it more and more, I believe there are no hidden bugs that I haven't discovered that are going to cost me lots of money one day, then I will, up the ante, as it were. So we got back testing, then after back testing, I don't know why I like to be consistent with my capitals. Back testing, forward testing, and then scaling up real trading. Spelling is not my strong point. I'm much more of a math guy. That's, basically it. The three major phases. Right now I'm in the first phase. I'm in the backtesting phase. And there are several parts to this. I'll give myself some more room here. So we want to get historical data. As far as the backtesting goes, let me just... Backtesting. There are a few different parts to this. So the first part is we obviously need data. So we need to get the data from somewhere. I've been using an API. There are several APIs out there where you can get historical market data from. You can get it in several different time frames, different formats. It just depends on what particular API you want to use. I have been using the Alpha Vantage API up to this point, but I will get into that in greater detail later. There will be subsequent videos that go into further detail. So we need to get the data. We need to do work on the data. So create algorithms, run these data sets through these algorithms, and then get a result back. And then we need a way of spelling, analyze and visualize the data. So this is the data scientist, data analysis part of it. We need a way of analyzing and visualizing the results that we get back from doing our algorithm tests, just to see what's going on. I mean, when analyzing data, there's a lot of different ways that data can be misinterpreted. There are a lot of ways you can get a false positive. You can get something that looks promising and, it's really not. One example would be, let's say you do a test and you run an algorithm against several different assets and you win, you make a profit. and it was a bearish algorithm. You know, it was trading to the upside. It was taking long positions. And he made a profit, so that's good. But then what if you go back and you look at the overall market for that same period of time, and you know, the market experienced a 100% rally over that period of time, whereas your algorithm only experienced maybe a 20% gain on average. That would be an example of something that looks positive, but in reality, you would have been better off just buying stocks and holding them than wasting all your time doing this algorithm. So that's, you know, we need to be able to look back and see what happened, and then have a frame of reference to figure out what happened. Was this algorithm good? Was it bad? What did it do? We need to look at the trades that it made and, you know, see were there any huge spikes or dips. You know, is there any way that anything we can do to maybe mitigate risk or take advantage of huge gains? Like maybe, you know, you're based on the rules that you gave your machine, the algorithm that you programmed. Maybe at one point you were up like 200% on something, and then you lost most of it and ended up with a 50% gain, which is good, but, you know, you could have got a lot more. Is there anything you could have done to cashed out early? You know, there's lots of things to take into consideration, lots of things to look at. So we need a way of analyzing and visualizing the data. So where I stand now on this project, I have been working on for the past couple of months a framework for retrieving the data from an API and then creating algorithms to do work on the data. I have done this in Java. There's no specific reason why I chose Java. I like the fact that it is essentially platform independent. Any machine that can install the Java runtime environment or Java development kit can compile and run the same Java source code. Aside from that, Java is just the programming language that I'm most comfortable with. But this is not a Java-specific project. I will most likely use several different programming languages throughout this project. But the framework that I've created, I have a beta version of it now. And show a glimpse of it. I will have an overview video of where I'm at with that at some point in the near future, but I have this, I'm calling it for now the Trading Insight Framework, and I have a beta of the first version. None of this is final, and this will all, I'm sure, change and evolve as time goes on and I get more advanced in this project, but this is a starting point. So I have several different packages in here. I have this pretty well encapsulated, hopefully not overly encapsulated, but I wanted it to be modular so that different parts of it could be changed and replaced as necessary. And as I find maybe better or more efficient ways to go about doing things, I can change one thing without having to reinvent the wheel and start over from scratch. So the basics of it are I have this query class that all it does is talk to the AlphaVantage API, and it retrieves data from that API. And then I have my data package here that deals with taking that data and doing things with it and presenting it in a form that is usable. And then what that does is hands it over to my algorithms. And I have several different abstract. I've got a friend who's bugging me right now. Anyway, these abstract algorithm classes here that you would basically extend. You would create a child class of one of these to create a specific algorithm. And like I said, I will get into further detail in the future, subsequent videos of how all this stuff works and as the project progresses. But that is pretty much it for now. Algorithmic trading, major project, first video, introduction. We got to get the data. We got to do work on the data. We have to visualize and analyze the data. I haven't really figured out what I want to do with that yet. I've experimented with Excel. If you watch my other videos, you know I like Excel. I do a lot of things with Excel. For this, though, the data, there's so much data when you're talking about the stock market, especially if you're looking at back testing something for several years of historical data. I've created CSV files. I've opened them with Excel. I've attempted to chart them, but when you get into charting data sets that large, I mean, I'm talking like a couple of years of minute level data is millions of data points. So Excel gets really clunky and cumbersome trying to chart and visualize things like that. So I'm looking into things like R. R is it's a programming language that deals specifically with analyzing, manipulating data, working with data sets. And there are lots of packages and pre-made stuff out there with R that I'm looking into. So, I will have an update on that in the future once I eventually settle on something to work with, at least temporarily. So that's where I am now. I've got this framework. I will be talking about the framework in videos in the near future. But that's it. I'm excited. I'm hopeful. Lots of opportunities. Very interested in where this takes me, the discoveries that I make, what I find. I'm really interested in these single algorithms, just analyzing one stock at a time. Also the idea of parallel. You see, I will talk a little bit about this. I've created 3 different abstract algorithm classes for now. There's a single algorithm, parallel algorithm, and dual algorithm. The single algorithm is we're just dealing with one stock at a time. So we're taking the data from one stock, we are following it through its progression, through the historical data, using technical indicators. I've only got a couple of them right now. They're surprisingly easy to develop. I think that's because for these standard indicators, the math is very clearly defined. It's out there on places like Investopedia, Wikipedia, stuff like that. You can find the math, and it's just a simple matter of translating that math into Java code, which isn't that difficult. But anyway, single algorithm, working with one stock at a time, applying different indicators to it, analyzing the data, using statistical analysis, things like that. Parallel algorithm is where you're doing 2 side by side. So I'm looking at 2 different assets side by side and sort of using them as indicators against each other. And I'll talk about that in future videos also. And then the dual algorithm, that is for simultaneously taking trades on 2 stocks or 2 assets, 2 different assets at the same time. So for instance, taking a short position in one and taking a long position in another at the same time. There's this idea of sort of convergence and divergence. Pairs of assets that tend to move together, like you could, for example, the S&P 500 and the QQQ, they tend to move together with the broader market, but there's some convergence and divergence that happens. So the idea is when things either, they converge too much or they diverge, they deviate from one another too much, you would take a short position in one and a long position in the other, or buy a put in one and a call in the other. And, when they revert back to normal, either, go the other way, then you make a profit off the difference, off the convergence or divergence. I'm doing a horrible job of explaining that, but I'll talk about that more in the future. But anyway, that's what's going on. That's where I stand with this project, and look out for more updates to come. Later.